All right, today we're going to do something a little different. We're opening up a time capsule. This is an internal banking industry presentation from way back in early 2001, and it gives us this absolutely fascinating peek into the financial world right before everything changed. We get to see it all through the eyes of the insiders who are running the show. So let's dive in.
So, picture this. It's January 11th, 2001. The dot-com bubble? Yeah, that just burst. But the really big stuff, the events that would completely shake the financial world to its core, that's all still just over the horizon. At this exact moment, the giants of banking, they felt invincible. But what they didn't know was that the ground right under their feet was already starting to crack.
And here's the crazy part. This isn't us looking back with 20/20 hindsight. Nope. This comes directly from their own presentation. This is how they saw themselves. They knew they were losing their grip, they knew the old structures were failing, and they absolutely knew they were taking on more risk. This, right here, is the central conflict of our whole story.
Okay, so to really get why they were so anxious, you first have to understand the empire they were trying to protect. You know, for decades, commercial banks were the undisputed kings of American finance. No question.
And even at the turn of the millennium, there were still absolute giants. Just look at this slide. Depository institutions. We're talking about your everyday commercial banks. They held over a third of all financial assets in the U.S. That's a bigger slice of the pie than any other single group. But here's the twist. That number, 34%, it wasn't really a sign of strength. It was actually a warning sign. It was the result of a long, slow-motion crumbling that was threatening their very existence. And wow, this next slide just lays it all out crystal clear. Back in 1980, banks held almost 60% of all financial assets. 60%! Fast forward just 2 decades to 2000, and that number has plummeted to 34%. I mean, they'd lost almost half their kingdom. So the big question is, where did it all go?
Right, so this empire wasn't just falling on its own, oh no. It was being dismantled piece by these new, scrappy competitors who were way nimbler and had a lot less regulation to deal with, and they were going right after the most profitable parts of the banking business.
First up, they came for the deposits, things like commercial paper and money market funds. I mean, back in 1970, they were barely a blip on the radar, but by 2000, they had exploded into a $1.2 trillion industry. That's money being pulled directly out of traditional bank accounts. And then they came for the loans. Take the junk bond market, for example. In 1980, it was less than $10 billion a year. Peanuts. By 1996, it was over $50 billion a year. Suddenly, companies that used to have to go to a bank, hat in hand, could now get cash directly from the capital markets. They were cutting the banks out of the deal completely.
So, faced with this existential threat, the banking industry knew it couldn't just sit there and take it. They had to fight back. And boy, did they. They came up with this bold, 2-part strategy that was about to reshape the entire financial landscape.
The plan was simple but aggressive. Part 1, get bigger. If you can't beat the competition, just buy them up. Consolidate all that power into fewer, massive institutions. And Part 2, change the game. The old business model was clearly dying, so they had to invent a brand new one. And this slide right here, this shows that get bigger strategy in action. Just look at that red line for mergers. It's skyrocketing. At the same time, the creation of new banks slowed to a crawl. Why? Because thousands of these smaller players were just being swallowed up by the giants.
And the scale of these deals, it was just staggering. In the year 2000 alone, you had these massive deals like Chase Manhattan buying JP Morgan for over $34 billion. This wasn't just business, it was a battle of titans. And it was creating these institutions that were so big, so interconnected, they'd soon earn that infamous name, too big to fail.
But, getting bigger was only half the battle. The second part of their strategy was, honestly, far more consequential. They basically rewrote the entire rule book on what it even meant to be a bank.
The old model was pretty simple, right? You take in deposits, you make loans, and you earn your money on the interest rate spread. Easy. The new model was all about generating fees. Fees for services, fees for trading, fees for packaging up loans and selling them off instead of holding them. It was a huge shift from a stable, kind of boring business to a fast-paced, transactional one.
And man, this slide shows you just how wildly successful that shift was.
For the big banks, fee income went from about a quarter of their revenue back in the 80s to nearly half by the year 2000. On paper, the new playbook was working like a charm.
But there was a hidden cost, a big one. See, to generate all those fees and chase those higher returns, banks had to start making bigger and bigger bets. They started taking on risks that would have been completely unthinkable just a decade earlier.
And here's the proof. Just look at the explosion in so-called off-balance sheet derivatives. What are those? Well, they're basically complex financial bets that don't even show up on the main accounting books. In just 4 years, the value of these bets grew from $5 trillion to an almost unimaginable $25 trillion. That's a 5-fold increase. This was a massive, hidden buildup of risk in the system, and almost nobody could see it.
And get this wasn't some deep, dark secret. The insiders who were giving this presentation in 2001, they were already seeing the cracks appear. They flat out noted that all this new risk-taking was leading to more bad loans and more write-offs. The warning signs were flashing right in front of them.
So here's the real kicker. At the exact same time that banks were taking on vastly more risk, a lot of it hidden, they were also shrinking their safety cushion. The reserve ratio, which is just the money they set aside to cover bad loans, was at its lowest level in a decade. Think about that. A smaller cushion for bigger risks. I mean, that's a recipe for disaster. All right, so this brings us to the end of our little time capsule journey. As of January 2001, the banking industry had just gone through a complete revolution. Let's just quickly recap what this brave new world looked like. By all their own metrics, they were a smashing success. They were more profitable than they had ever been. Power was concentrated in the hands of a few mega banks, and their new model, all about fees and transactions, was firing on all cylinders. But, and it's a huge but, all of this success was built on a foundation of much, much higher risk.
So from where they were standing in early 2001, they had stared into the abyss, and they had won. They fought off all that new competition and built a new banking empire that was more powerful and more profitable than ever before.
They had built a system that was perfectly engineered to thrive in the world they knew. But the one question they weren't asking, the question that just echoes through the years all the way to today, is whether that system could survive the world that was just around the corner.